Hi everyone, welcome to ACCA Financial Accounting. And now we are in Part A, the context and purpose of financial reporting. And I'm going to share you about Chapter 1. So what is financial reporting? It is a way of recording, analyzing, and summarizing financial data. It is the name given to transactions carried out by the business and are recorded in the books of prime entry. The transactions are analyzed in the books of prime entry and the totals are posted to the ledger. It is also finally summarized in the financial statements. There are three types of business entity, which are sole traders, partnership, and limited liability company. For a sole trader, it is a person trading on his own. The person controls, manages, and runs the business. Legally, the person and the business are one and the same. All financial risks are taken by the sole trader, and all of the sole trader's assets are at risk. Meanwhile, for partnership, a business owned and run by two or more people with a common view to making a profit. The profits are usually shared according to a written agreement. And finally, for a limited liability company, it is a separate legal entity owned by shareholders who appoint directors, which are managers, to run it. It is subject to a statutory regulation, for example, the Companies Act. There are 5 advantages for a sole trader. The first one is limited paperwork and therefore costs in establishing this type of structure can be minimum. The owner also has complete control over the business and it is highly flexible. The owner is also entitled to profits and the ownership of assets. And finally, less stringent reporting obligations compared with other business structures. For partnership, there are 5 advantages. Firstly, there is less stringent reporting obligations. Additional capital can also be raised because more people are investing in the business. Division of roles and responsibilities and increased skill set by the different abilities of the partners. They can also share risk and losses between more people. And finally, there are no company tax on the business. And finally, for 5 advantages of limited liability company. A limited liability company has a separate legal identity from its shareholders. It makes the investment more secure and raising finance easier. It is also relatively easy to transfer shares from one owner to another. And finally, there are tax advantages to being a limited liability company. However, there are also disadvantages of being a sole trader, partnership, and limited liability company. For the sole trader, personal property may be vulnerable for debts and other business liabilities. The owner is personally liable for all debts, which is unlimited liability. There are also may be issues of continuity of business in the event of death or illness of the business owner, and may lead to long working hours without the normal employee recreation leave and other benefits. Large sum of capitals are also less likely to be available to a sole trader. For the advantages of partnership, there are also costs associated with setting up partnership agreements. They are also personally liable for all debts, which is unlimited liability unless they form an LLP. There is slow decision making due to the need of consensus between partners when they are discussing about the business matters. There also may be issues of continuity of business in the event of death or illness of the partners. And finally, unless a clause is written to the original agreement, when one partner leaves, the partnership is automatically dissolved and another agreement is required between existing partners. And finally, there are 4 disadvantages of limited liability company. Firstly, a limited liability company have to publish annual financial statements. Secondly, the financial statements of larger limited liability companies have to be audited by the internal and external auditors. The share issues are regulated by law, and finally, limited liability company financial statements have to comply with legal and accounting requirements. There are two types of accounting, which are financial accounting and management accounting. For financial accounting, it is concerned with the production of financial statements for external users. These are a report on the director's stewardship of the funds entrusted to them by the shareholders. For management accounting, it is an integral part of management activity concerned with identifying, presenting, and interpreting information used for formulating strategy, planning and controlling activities, decision-making, and optimizing the use of resources. There are two types of users of financial statements, which are internal and external. Internal users are owners, managers, employees, and other parties who are directly connected with a business. External users are potential investors, banks, government agencies, and other parties who are outside the business and need financial information about the business for a diverse number of reasons.
User and information needed. Investor, provider of capital are concerned with the risk and return of their investment. They need information for decision making and to assess the entity's ability to pay interest or dividends. The second user is suppliers. The suppliers need information to decide whether to extend loan facilities or to determine whether repayment will be repaid when due. Next, management. To plan, make decisions, and control operational activities. Financial analysis of the financial statement may form part of a management review. And segmental information is often required. The customer needs information for continuance of supply of goods or services is important for long-term involvement with or dependence on the entity. Employees needed information for stability and profitability of employers, while financial institutions like banks and other lending companies need the information to decide whether to extend loan facilities or to determine whether repayment will be repaid when due. The general public and media need information to measure the following. First, contribution to local economy, like number of employees and patronage of local supplier, or trends and recent development in prosperity and range of activities. The next user is government entities and their agencies, like tax authorities. Need information to allocate of resources and therefore activities of entity. And information used to regulate activities, determine taxation policies, and as the basis for national income and similar statistics. The potential investor, risk and return of making an investment may be assessed on the basis of published financial information. And the last user, the environmental groups. The environmental groups need the information on how the entity is working to keep the environment green is increasingly reported in annual report. The component of financial statement. There are 5 components of financial statement. The first one is statement of financial position. Statement of financial position is a statement of assets and liabilities at a given point in time. Next, the statement of profit or loss. The statement of profit or loss is a summary of transaction and event over a period of time. The statement of cash flow is A report on cash flow activities classified between operating, investing, and financing activities. The statement of changes in equity. The statement of changes in equity is a statement to explain changes in equity over a period. And lastly, accounting policies and explanatory notes. These are usually included because the financial statements are often too complex to understand without additional details. Next, the assets and liabilities. Assets are items belonging to a business and used in the running of the business. They may be non-current or current. Liabilities are sums of money owed by a business to outsiders such as bank or a supplier. Assets. Current assets. Assets which are expected to be realized, convert into cash in the business normal course of trading. Disclosed in the statement of financial position with the least liquid item first, usually inventory. The example of current asset is inventory, receivables, cash, short-term investment, and prepaid expenses. Non-current asset is any intangible or tangible asset acquired on long-term basis to be used in providing a service to the business, not held for resale in the normal course for trading. The example for non-current assets are land and buildings, motor vehicles, plant and machinery, furniture, fixture and fittings, equipment, and long-term investment. The current liabilities are those liabilities which are payable within 12 months of the reporting date, such as payables, bank overdraft, loan, deferred income, and accrued expenses. Non-current liabilities is long-term liabilities payable more than 12 months after the reporting date, such as long-term loan, note payable, and loan stock. Next, we have equity. This is the residual interest in a business and represent what is left when the business is wound up. All the assets sold and all the outstanding liabilities paid. It is effectively what is paid back to the owners when the business ceases to trade. The accounting equation is assets equal to equity plus liability. The revenue. Revenue is income is derived from the main business activities for a period. Other operating income is income other than that derived from trading activities such as interest, dividends, or rental income. Income is increases in assets or decreases in liabilities that result in increases in equity other than those relating to contribution from holders of equity claim. The expenses. Expenses are the cost of running the business for the same period. Expenses are decrease in assets or increase in liabilities that result in decreases in equity, other than those relating to distribution to holder of equity claim. There are three operating expenses. The first one is selling. Next, the distribution. The administration is capital expenditure. Is expenditure which result in the acquisition of non-current assets or an improvement in their earning capacity. Capital expenditure are the expenses incurred by the firm for acquiring or upgrading or maintaining the tangible assets like plant, machinery, and building. While the revenue expenditure is an amount that is spent for an expense that will be matched immediately with the revenues reported on the current period income statement. These are the examples of capital and revenue expenditure.
Next, part B, the qualitative characteristic of financial information. Qualitative characteristics of financial statements. These are the attributes which make information provided in financial statements useful to primary users. There are two qualitative characteristics, which are fundamental and enhancing. Fundamental characteristic. The first one is relevance. It has the ability to influence the economic decisions of users and is provided in time to influence those decisions. Has quality of predictive value and confirmatory value. Relevance of information is affected by its nature or its materiality. Next one is faithful representation. It is the concept that financial statements be produced that accurately reflect the condition of a business. It must be accounted for and presented in accordance with their substance and economic reality, that not merely their legal form. This is known as substance over form. The qualities of faithful representation are neutrality, completeness, and accuracy. Next is enhancing qualitative characteristic. The first one is comparability. Able to compare the financial statement of an entity over time to identify trends, financial performance, and financial position. In order for the financial statement to be comparable, it must comply the concept of consistency and disclosure. Variability means that different knowledgeable and independent observers could reach consensus, although not necessarily complete agreement, that a particular depiction is a faithful representation. The number of users with the same information would be likely to reach the same conclusion. Information that can be independently verified is generally more useful for decision making than information that cannot. Next is timeliness. Timeliness means having information available to decision makers in time to be capable of influencing their decision. Generally, the older the information is, the less useful it. And lastly, understandability. Classifying characteristics and presenting information clearly and concisely makes it understandable. It depends on the way in which information is presented and the capabilities of users. It is assumed that users have a reasonable knowledge of business and economic activities and are willing to study the information provided with reasonable diligence. For information to be understandable, users need to be able to perceive its significance.
Let's continue to our lesson. This all is the accounting concepts that occur in business. Firstly is the accrual concept. Accrual concept is a revenue and expenses are recognized when they occur, not as cash is received or paid, and recorded in the accounting record and reported in the financial statement of the period to which they relate. The next concept is the business entity. Business and personal transactions must be accounted separately, such as drawing. The next concept is going concern. Business entity will continue to trade for the foreseeable future. Is applied on valuation of non-current asset at carrying amount. Thus, the depreciation is accumulated every year and will decrease the value of non-current asset. The next concept is consistency. Similar transactions are accounted for in a similar way. In preparing account, consistency should be observed in two respects. Firstly, similar items within a single set of accounts should be given similar accounting treatment. Second, the same treatment should be applied from one period to another in accounting for similar items. This allows valid comparison to be made from one period to the next. And then, the next concept is materiality. Materiality is an item is regarded as material if its omission or misstatement is likely to change the perception or understanding of the user of the information. An item may be considered material based on either its value or nature within the financial statement. In assessing whether or not an item is material, it is not only the amount of the item which needs to be considered, the context is also important. The next concept is prudence. Prudence means including a degree of caution in making estimate under condition of uncertainty. For example, asset or income are not overstated, and liability or expense are not understated. The next concept is historical cost. Recognizing items in the financial statement based on price paid. In general, accountants prefer to deal with objective costs rather than with estimate value. So there are some problems with the principle of historical cost. First is the wearing out of assets over time. Second, the increase in market value of property. And the third is inflation. For the next concept is fair value. Fair value is the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. And then the next concept is monetary unit assumption. Monetary unit principle is the assumption that money itself is treated as a unit of measurement, and all transactions or economic events are recorded in the accounts of a business and can be measured and must be measured in monetary terms by a currency. For example, ringgit Malaysia or dollar. Last but not least, the time period principle. The time period principle is an accounting principle which states a business should report their financial statement appropriate to a specific time period. The time period concept is one of the fundamental accounting principles and rules that we have studied before and applicable to both cash accounting and accrual accounting. That's the end of my slideshow. Have a nice day and thank you.